Hey, what is up, guys? It's Clockyy Trades here, back out with another video. Now, before we begin, this is not financial advice. This is just for entertainment purposes only. But yeah, this is basically a video about spreads. It's basically more of a definition or more in depth to put credit spreads, to be exact. I know I already made a video about this, but this is just for people that want to be. I quite don't understand what put credit spreads are. But this is basically an example of, let's just say I don't do technical analysis. Let's just say I'm an average Robinhood trader and I am just wanting to dabble into spreads, for example, and that's to say I want to do put credit spreads because they give a better return. Let's just say than call debit spreads or any other spread, because with a put credit spread, you get a premium, a credit that you get retrieved into your account until you buy to close, until you give back money to close out the option contract. So let's just say Unity right now is down about 8% in a week. The low is, yeah, it's $145. So let's just say I want to pick a safe-ish strike prices, which I mean it's been a run up for the past 3 months, so it's up 94% in the past 3 months. But if I want to say, let's just say I want to do a January 15th, 2021 put credit spread, and I want to be safe. I already have a few, but let's just say I want to be safe, and I want to do like a 130 and a 125. Well, that would give me a $200 in credits, right? So I would get a minimum of $200 in credit, but it would cost me 500. So you subtract those two. That's basically how much you basically risking. You're risking 300, because if it doesn't go your way, if the strike price at 145 dips below 125, and you let it expire at January 15th, well, you lost this play, but you still get to keep the 200 credit, but you still lose the 300 because you keep 200, but it costs you 500. So you subtract those two, and you're risking your own $300, because you still get to keep this if it doesn't go your way. Now, for people that don't understand, like in the money, out of the money, technically this is out of the money, but it's in the money because it's just easier explanation below the strike price. If you guys do cash secured puts, it's in the money, I guess you can say. But this is just an understanding of more of it. But obviously you could do technical analysis, which helps with doing spreads like this. But like I said, I'm not a financial advisor, but let's just say I wanted to be safe. I could do this and get this credit. Now with the theta decay, so with like theta decay on this, you're losing $24 per day on this contract. Now if you had a 130, if you just had a 130, but at the same time, Theta's on your side with spreads. That's why I prefer spreads, or anyone who's dabbling into options. First of all, it's risky in any option that you choose, but it's still a lot safer than just buying, let's just say, a naked call or a naked put, for example, because each day you keep this for, it loses value as it's getting close to the expiration. The only way of making money is for it to drastically go up. So you see how it's minus 4%, and these contracts are minus 15%. That's triple. I'd rather do a put credit spread and be down, let's just say 2%, 3%. But as it's getting closer to the expiration, your contract's getting worthless. So meaning so how I said it's like $200 minimum credit. So if it's staying above 130 and it's getting close to the expiration, well, this 2.0 might 2.00, which is $200, might be let's just say 0.50. Well, you made $150. Like it says, your profit, your max profit on this is already 150. You could sell that and only pay back $50. So you'd make 150 off of one contract. And people do these with a lot of contracts. That's how people make a lot of money, because they don't have to wait that long for it to expire worthless, or they want to make a certain amount of profit, let's just say 30, 40% off this contract versus all 100% of $200. You can do that, but it's you gotta wait till the expiration date, or if the spread, or not the spread, or if the stock goes up so much. But yeah, that's it for this. If you guys have any questions, that's what a put credit spread is. I mean, I normally look at technical analysis as well, but you can also just, if you're an average Robinhood trader, you can also look through Robinhood and see where the lowest it's been. If you want to make like a 130, 125, so at that point it was around November 23rd, November 24th is where it hit that range. So you still have a lot of time. Obviously, it's been going back down lately, but it's something that I would do. I wouldn't advise doing that play because I'm not a financial advisor, but yeah, this is a bit more understanding, a bit more deep thought of what this is. If you guys have any questions, like I said, just let me know in the comments down below. I'm open. I also have a Discord. I will put that in the description as well if you want to message me about certain things. And I hope you guys enjoyed. I'll see you guys in the next video. Peace.